Why do trades keep going against me? It's a common experience for traders to find their positions moving against them. This can be a frustrating and disheartening occurrence, leading to doubts about one's trading abilities. However, understanding the underlying reasons for adverse market movements can help us develop strategies to mitigate their impact and improve our trading performance. By the way, if you are looking for a reliable broker with very low deposit requirements and quick withdrawals, see the links in the description box below. One of the primary causes of adverse market movements is incorrect analysis. Whether it's misjudging economic indicators, political events, or company news in fundamental analysis, or misinterpreting charts, patterns, or indicators in technical analysis, errors in judgment can lead to poorly timed entries and exits. Another common factor is poor risk management. Overtrading, trading with excessive leverage, or neglecting to use stop-loss orders can significantly increase exposure to risk and amplify losses. When trades go against us, these factors can compound the negative impact. Market volatility is another significant contributor to adverse market movements. Unexpected news, such as geopolitical tensions or natural disasters, can cause markets to fluctuate rapidly, making it difficult to predict price movements. Additionally, shifts in overall market sentiment can influence prices, even if underlying fundamentals remain unchanged. Psychological factors also play a significant role in trading performance. The fear of loss can lead to impulsive decisions and holding on to losing positions for too long. Confirmation bias, the tendency to seek out information that confirms our existing beliefs, can cloud our judgment and make it difficult to recognize when a trade is not working. To improve our trading performance and mitigate the impact of adverse market movements, it's essential to adopt a disciplined approach. Continuous learning, staying updated on market news, economic indicators, and trading strategies is crucial. Implementing strict risk management rules, including stop-loss orders and position sizing, is another key factor. Developing strategies to manage emotions and avoid impulsive decisions can also help. Diversifying investments across different assets can reduce risk, and backtesting trading strategies using historical data can identify potential flaws. By understanding the reasons for adverse market movements and adopting a disciplined approach, we can improve our trading performance and increase our chances of success. Remember, even the most experienced traders face challenges. The key is to learn from our mistakes and continuously strive to improve our skills.